FinanceAI is an advanced AI-powered financial model that leverages random forest algorithms to provide accurate predictions and insights into key financial metrics. By analyzing historical data, FinanceAI forecasts essential profitability indicators such as gross profit margin, operating margin, net profit margin, return on equity, ROE, and debt-to-equity ratio. This model empowers financial analysts and decision-makers to optimize financial performance, enhance profitability, and maintain a balanced financial structure. FinanceAI serves as a robust tool for strategic planning, helping businesses navigate complex financial landscapes with data-driven precision. Pradeep K. Suri. Model Architect. Author, Researcher, and AI-DNN Architect. From a management perspective, analyzing the given financial metrics, gross profit margin, operating margin, net profit margin, return on equity, and debt-to-equity ratio, over the years 2022 to 2025 provides valuable insights into the company's financial health, profitability, and overall performance. Here's how to approach the analysis. 1. Gross profit margin, %. Definition: gross profit margin indicates how efficiently a company is producing and selling its goods relative to the costs of production. Analysis: the gross profit margin shows a slight increase from 40.64% in 2022 to 41.79% in 2023, but then stabilizes around 41.51% for 2024 and 2025. Management insight: this stability suggests that the company has managed to maintain a consistent cost structure relative to its sales. Management should investigate the factors contributing to the slight dip after 2023 to ensure no adverse cost pressures are emerging. 2. Operating margin, %. Definition: operating margin measures the percentage of revenue left after paying for variable costs of production, such as wages and raw materials. Analysis: the operating margin increases from 26.42% in 2022 to 27.76% in 2023 and then stabilizes at 27.43% for 2024 and 2025. Management insight: the improvement in 2023 reflects better control over operating expenses or increased efficiency. Management should maintain this efficiency or identify opportunities for further improvements. 3. Net profit margin, %. Definition: net profit margin indicates how much profit a company makes for every Rs of revenue after all expenses have been deducted. Analysis: the net profit margin increases from 28.95% in 2022 to 30.48% in 2023, then slightly decreases to 30.11% for 2024 and 2025. Management insight: the increase in 2023 suggests effective cost management and profitability enhancement. The slight decrease afterward may warrant further examination of any potential rising costs or reduced revenue streams. 4. Return on equity, ROE, %. Definition: ROE measures a company's profitability relative to shareholders' equity, indicating how effectively management is using equity investments to generate profits. Analysis: ROE increases significantly from 35.92% in 2022 to 40.87% in 2023, then slightly decreases to 39.58% for 2024 and 2025. Management insight: the strong ROE in 2023 suggests effective utilization of shareholders' equity to generate profits. Management should monitor the slight decline in the following years to ensure continued strong performance and shareholder returns. 5. Debt-to-equity ratio. Definition: the debt-to-equity ratio measures a company's financial leverage, indicating the proportion of debt used to finance the company's assets relative to equity. Analysis: the debt-to-equity ratio remains constant at 0.6 throughout the period. Management insight: a stable debt-to-equity ratio suggests consistent financial leverage, which can be a sign of prudent financial management. Management should continue monitoring debt levels to maintain a balanced capital structure. Overall management perspective. Profitability: the company has shown an overall improvement in profitability from 2022 to 2023, followed by stabilization. This indicates strong financial management and efficiency in operations. Efficiency: the stable gross profit margin and slight increase in operating margin suggest effective cost management and operational efficiency. Financial leverage. The consistent debt-to-equity ratio indicates that the company is maintaining a balanced approach to financing its operations, which reduces financial risk. Recommendations. 1. Sustain profitability. Focus on sustaining and improving profitability by exploring cost-saving opportunities and optimizing operations. 2. Monitor margins. Keep an eye on slight decreases in net profit margin and ROE after 2023 to identify and mitigate any emerging issues early. 3. Debt management. Continue to maintain a prudent debt level, ensuring that the debt-to-equity ratio remains stable or improves, reflecting strong financial health. 4. Long-term strategy. Consider strategic investments or innovations that could drive future growth while maintaining current financial stability. This analysis provides a strong foundation for making informed decisions about the company's future strategies and financial planning. Explanation of the bar chart. Financial metrics, 2022 to 2025. The bar chart represents key financial metrics for the years 2022 through 2025. The metrics are displayed as percentages or ratios and include 1. Gross profit margin, %. Shown in blue. Represents the percentage of revenue that exceeds the cost of goods sold, COGS, indicating the efficiency of production and pricing. It remains consistently high across the years, with slight fluctuations. 2. Operating margin, %. Shown in green. Measures the percentage of revenue left after deducting operating expenses, showing the company's profitability before interest and taxes. It shows a slight decline from 2022 to 2023 and then stabilizes in 2024 and 2025. 3. Net profit margin, %. Shown in red. Indicates the percentage of revenue left after all expenses, taxes, and interest have been deducted, representing the company's overall profitability. The net profit margin mirrors the operating margins trend, with a slight decrease from 2022 to 2023 and stabilization thereafter. 4. ROE, return on equity, %. Shown in purple. Measures the profitability of a company in generating profit from shareholders' equity. It indicates how effectively management is using a company's assets to create profits. The ROE metric shows an increase from 2022 to 2023, then remains consistent through 2025, indicating efficient use of equity to generate profit. 5. Debt-to-equity ratio. Shown in orange. Indicates the relative proportion of shareholders' equity and debt used to finance the company's assets. A lower ratio typically implies less risk. This metric is very low across all years, suggesting the company has a conservative debt structure. Key observations. Consistency. The gross profit margin remains consistently strong, indicating stable revenue generation compared to COGS. Stability. Operating and net profit margins show slight variations but overall stability, reflecting controlled operating costs and consistent profitability. Efficiency. The increase in ROE from 2022 to 2023, followed by stability, suggests efficient use of equity capital. Risk. The low debt-to-equity ratio throughout the years indicates low financial risk with minimal reliance on debt financing. Overall, the chart reflects a healthy financial outlook with strong profitability, efficient use of equity, and low financial risk from debt. Evaluating the bar chart for investment decisions. Buying shares in ABC Company. When considering buying shares of ABC Company, the bar chart titled Financial Metrics, 2022 to 2025, provides valuable insights into the company's financial health and potential for future growth. Here's how each metric can inform your investment decision. 1. Gross profit margin, %. Why it matters. A consistently high gross profit margin indicates that the company is efficiently managing its production costs relative to its revenue. This suggests that the company has strong pricing power and cost control, which can lead to sustainable profitability. Investment implication. ABC Company's stable gross profit margin across 2022 to 2025 suggests that it is likely to continue generating solid gross profits. This is a positive sign for potential investors looking for companies with strong fundamentals. 2. Operating margin, Why it matters: the operating margin reflects the company's ability to manage its operating expenses, which include selling, general, and administrative costs. A stable or increasing operating margin indicates good cost management and operational efficiency. Investment implication: the slight decline in operating margin from 2022 to 2023, followed by stability, might raise questions about potential challenges the company faced during that period. However, the margin remains solid, indicating that the company has successfully controlled its costs. Investors might consider this a sign of resilience. 3. Net profit margin, %. Why it matters: the net profit margin shows the percentage of revenue that ultimately becomes profit after all expenses, taxes, and interest are deducted. A stable or increasing net profit margin is a strong indicator of overall financial health and profitability. Investment implication: the net profit margin's trend is consistent with the operating margin, suggesting that the company's bottom line remains strong despite minor fluctuations. This consistency can reassure investors that ABC company is capable of delivering reliable profits, making it an attractive investment. 4. Return on equity, %. Why it matters: ROE measures how effectively a company is using shareholders' equity to generate profits. A higher ROE indicates better efficiency in generating returns for investors. Investment implication: the increase in ROE from 2022 to 2023 and its stability thereafter suggests that ABC company is efficiently using its equity capital to generate profits. This efficiency is a strong positive indicator for potential investors, as it suggests a high return on their investment. 5. Debt-to-equity ratio. Why it matters: the debt-to-equity ratio indicates the proportion of debt the company uses to finance its assets compared to equity. A lower ratio implies lower financial risk, as the company is less reliant on debt. Investment implication: the very low debt-to-equity ratio throughout the period suggests that ABC company has a conservative approach to debt, reducing the financial risk for investors. This makes the company a safer investment, especially in uncertain economic conditions. Conclusion: positive indicators: the strong and stable gross profit margin, consistent net profit margin, and increasing ROE are all positive indicators for ABC company. These metrics suggest that the company is profitable, efficiently managed, and offers good returns on equity, making it an attractive investment opportunity. Risk considerations: the low debt-to-equity ratio reduces financial risk, making ABC company a potentially safer investment. However, investors should consider the slight dip in operating and net profit margins from 2022 to 2023 and assess any external factors that might have caused this. Overall, the financial metrics depicted in the bar chart suggest that ABC company is a well-managed and financially stable organization, making it a strong candidate for investment. Thank you.